Hi, in today's video, I'm actually going to talk about what exactly is the derivative market or what exactly are derivatives. Now, typically in the stock market, there are three ways you can actually invest. The most common is actually buying stocks, right? Getting to a chart is essentially you buy a company at X value and you make money when you actually sell that at Y value, hoping the difference between X and Y is positive, you make a profit. But what happens if you are reading about a company, doing your research about companies, and realize that maybe in the short term, the company is maybe undergoing stiffer competition or pumping in a lots of money and new R&D, which is taking up a lot of their assets and time and management. So you may see a dip in the price in that, but you still believe in the company on the long run, right? And essentially, that's kind of where potentially second way of trading comes in, which is futures. Futures essentially is you have the ability to sell a stock now and buy it at a lower price, ensuring that you have the flexibility not only of the market going up, but also if you feel that a company is doing badly or some bad results may come in, you can potentially short that stock. That's what futures is. Now, options is actually the third potential way that people can invest in the stock market. And look at it this way, like this is say a stock price that you're looking at, and what happens in this scenario over here, like the market goes up, comes down, goes up, comes down, and essentially stays say in this range for a very long time. If it's a stock, you're looking at 0 to 1% increments over a long period of time and really tests you. Essentially, that's kind of where options trading kicks in. Is we look at more technical and not fundamental analysis to determine at what point the market gets saturated and there's a selling pressure, and at what point there is a buying opportunity and there is lots of movement happening. And as long as it comes in this range, we end up making a profit. Now, one thing you should know about the derivatives market is it's an actually a zero sum game. For you to buy a option or in a particular strike price, and I'll get into strike prices in a little bit or the next video, there has to be somebody who's going to sell it to you. So that is something that you need to understand. If you lose in one trade, it actually means that somebody else made in that trade, and vice versa. If you win in one trade, which means that somebody actually unfortunately has lost in that trade. Now, coming back to derivatives. Now, derivatives actually has a big misconception that it's mainly gambling or it's got very high risks. And the truth is it has high risks, but it also has higher rewards compared to stocks. We have a capability of using lesser amounts of money to make potentially larger profits in terms of ROI that we can actually work around. Uh, but if options is done correctly, and options we focus mainly on the fundamentals, if the fundamentals are proper and you study them well, it can be an absolutely lucrative business to get into. Now, coming back, what essentially options enables us to do is one other thing that it actually gives us is a lot of actual flexibility. We can trade for say just the morning hours and see if we can get this move up, and sometimes call it quits in 3-4 hours, and we can take our profits for the day and move out. Whereas in sort of stocks, you have to hold on for longer periods of time because the company doesn't really jump from A to B in a matter of 1 or 2 hours, unless, of course, there is news that is driving the price. But in general, you do not get to, or you get to see the profits of your stocks only after a longer period of time. In options, you have a lot of time flexibility. So even if you want to trade say only for a couple of hours, you may get a couple of trades in a day, ensuring you get your profit and you can enjoy the rest of the time. That's what options is. In the next video, I'm actually going to teach you what are some of the languages of calls, puts, strike prices, ATM, in the money, out of the money, to get you more well versed with a lot of the basic information you can get before we start getting into strategies and entries and stop losses and all of that. But for right now, options recapping has is another way to actually invest. Stocks is the first one where you only get money when you do buy a stock, goes up. Futures, you can actually short it first. In options is you have the ability to not only buy and sell, but can decide a upper level, a lower level. And the other thing I forgot to mention in options is there's always a time restriction to it. Like there is either a weekly or a monthly expiry. So what ends up happening is by the end of the week or by the end of the month, depending on the time frame that you choose to invest, you will know that you are in profit or loss. It can't be left open. Obviously, you can cut that position and take another position, but by and large, for each position or each trade that you take, there is a defined time frame. In stocks, there is an undefined time frame. You don't know when you have to exit. Here, you have to be able to choose the time frame in which you actually decide to trade as an opportunity to know whether you're going to make a profit or loss by this coming Thursday or not. So that is what options is. In the next video, I'm going to talk more about calls and puts and a little bit more of the lingo so you can understand directions of options trading.